Hello, hello. Good morning. We are here live. I'm here with David Leiter. Good morning, good morning. My name is Dr. Shefali Miglani, and I own a private practice for the last 20 years. For the last decade, I was doing normal primary care optometry, and then there was an opportunity to shift my practice to specialty care, and I did. And today I specialize in myopia management and dry eyes, both that allow me to help many more specialty patients and bring more private pay revenues into my practice. I'm also the chief medical officer for Hoot. Hoot is a company founded by my husband, Bob Miglani. Hoot is an automated software solution to help doctors convert patients from primary care to cash paying specialty care. Over the years, I got interested in personal development. And in that journey of personal development and growth, I got to meet a friend named David Leiter. David and I met through Tony Robbins' Platinum Partners, a powerful mastermind group where I've had the opportunity to learn from David both on stage when he's presenting at Wealth Mastery for the last few years and also off stage. He is a seasoned investor, the founder of the ultimateinvestor.com, and his experience includes years at Credit Suisse in investment banking. He brings both institutional level expertise and real world practical wisdom to the table for all of us and teaches us how not to make dumb investment mistakes. I'm bringing David here to you today because I see many of us doctors today need help in figuring out how to grow our specialty practices and businesses, but also where to invest those dollars that we work very hard to earn. Hi, David, and welcome.
Hi, Dr. Shefali. It's a pleasure to be here. I'm very honored to be on your podcast and look forward to talking to you today.
I'm very excited, David. Okay, David, as a doctor practicing in our specialties for many years, most of us are high earners, but we may not be high net worth. Most of the doctors think there's a pot of gold at the end of our practices when we sell them and our careers are over, only to realize that their cash out isn't as lucrative or not what they imagined. And they don't have anything set out for their retirement plan except just their practices. So what thoughts do you have in that case scenario where doctors just kind of think about their practices as their retirement plan?
Well, that's a great question. And I just want to start by saying I'm not a licensed financial advisor, so I cannot opine on people's personal situations when they want or need money. But I will tell you, generally speaking, that this is a common problem. If you're earning a lot of money and you're maybe living a lifestyle that's equal to what you're making, maybe you're not investing or saving that much. We all know that. People tell you save, invest your money. So that's not groundbreaking news. But I think what people need to realize is the effect of compounding. And if you can invest in reasonably good assets, and you can do that through public stock markets. And I know a lot of doctors have been pitched various things in the real estate field where they can invest in real estate, but that is a lot more complicated. And you need to realize that time is your friend. If you want to compound money, so you have a lot of money at the end when you're stopped working, you need time in the markets. It's not timing things in and out. And what happens a lot of times to people who are doctors, especially very intelligent people, they went through school, they did all these things I couldn't do, and then they get to the end and they think, well, I'm one of the smartest people around, which is likely true. But when it comes to investing, it's a different set of skill sets. It's a different way of thinking. And it gets them into trouble because they're used to being good at everything that they do in their daily life. And then they think, well, I'll be just good at this too. So we can get more into that. But that's basically what I think is you really need to put aside money now and not rely on that and just have the discipline. And then the question becomes, how do you invest that money?
Right, right. Yeah. Well, doctors are trained in to thinking very scientifically in like a scientific method and protocol, and in a stepwise process. What, if any, framework do you have for our doctors who are curious about investing and want to take the next step? How should we start thinking about filtering out the bad from the great investments? What advice do you have for us on that? How do we get started with that?
Yes. Well, it's a great question. I mean, look, when you are making a lot of money, relative to the rest of the world, if you're a doctor, you're usually high income earner, there's a lot of people pitching investments. So there's all sorts of things. Some things, and just probability wise, they're not all going to be good. So people pitch real estate deals, or they tell you invest in stocks, or you hear something about hot industry, AI, or something that's coming up. And so what happens is you're so busy with your job and working and your career that you don't have the time or any kind of framework, as that's actually what I call it, to sift through what is good and what is bad. And so there is a simple sort of criteria or set list of checklist of things you can go through. One is anything you invest in, you need to understand the business. If you're going to do a private investment, this is where people get into trouble, and I don't recommend it. By the way, you should have a financial advisor to plan out and keep you invested to so they can look at your personal situation. How much money are you making? How much can you invest? When do you expect to retire? That type of thing. But what happens is people, again, because you're a highly intelligent group of people, they tend to think, well, I can, I'll do this. This sounds good, but they have no framework. So, hey, do you understand what you're doing? So if someone comes to you with a real estate deal, do you actually understand the business model? Do you understand, that area, that what is happening in that area? And then secondly, can you reasonably predict the future? This is where people get into problems. So they read a presentation of a real estate deal, and it says your rents are gonna go up 3, 4, 5% a year, and you're gonna sell it, and you're gonna make 2.5 times your money in 5 years. That's what every investment pitch says. And I got news for you, it doesn't work that way. And a lot of people got into trouble with that because the people who are pitching it, this is the third part, is can you predict the future? Can you see where that business or that property will be 5 or 10 years from now? And third, does it have strong management? If you're investing with somebody else, a lot of these people don't have a track record that are pitching real estate investments. They've been doing it for 5, 6, 7, 8 years. But everything went up. From the great financial crisis, 2008, 2009, things bottomed out. People didn't like real estate. It was hated, and everything was cheap. So a lot of people got involved and bought real estate, and it went up. But then they bought, because it was more luck than skill, people bought, then they started raising money and saying, well, I'll teach you how to do it. Then it gets to 2021, 22, people did deals at that time, and a lot of those deals have gone bad. I've seen a lot of people who come into my groups after they've already in a problem, and they say, geez, I wish I talked to you earlier. But so it's a lot of it was more luck than skill. So number 3 is who you're investing with. Strong management. If you're looking at a business or a company, it's like, if you're going to buy another practice, you look at who's the management there. You try to figure that out. 4th is, can I get the asset at a fair price? Now, this is a whole thing about valuation, which is probably more complicated than we can do on this call. But that's the kind of thing I do teach in my groups and courses and event, is how to value assets. And so that is a big deal. And most people don't know how to do it. Most people make a decision to invest. They feel good. They talk to somebody. They say, I like that person. I'll give them money. They seem like they know what they're doing. This is like a recipe for disaster, because a lot of people are good at talking. And there's actually seminars that teach you how to raise money. So they come to you and they say, let's go after the doctors because they're making a lot of money. They got a lot of money to invest, and they go after the doctors. And then you're busy and you say, oh, I like that guy. I'll give him money. And then you get into a problem. And the 5th thing and the final thing is anything you buy, you have to have what they call a margin of safety. I always refer to Warren Buffett, who's one of the greatest investors of all time. The principles I'm teaching are his principles. He returned over 19% a year in his company, Berkshire Hathaway, for 58 years. That's pretty incredible. 19% compounding. So his principles work. And it's like in health and medical, I bet most of you would agree, even before a patient comes into the office, there's a few things: get enough sleep, exercise, eat well, right? These are the principal basics that will actually avoid you from maybe going to the doctor um, a lot less. So there's principles in investing too.
Okay, great. Well, I have some follow-up questions. Can you what does strong management mean? I mean, I know that I was recently approached by a friend. He's been a friend actually in the Platt community, and he does real estate. And I mean, like, he's a great guy. I'm probably having a call with him next week to invest. Well, what questions do I need to ask him, or how do I vet him as part of? I mean, he has a great deck, pitch deck. I looked through it before. What are some couple of tips that you can give me that I can go into that call and vet him as a strong management type?
Okay. That's such a great question. And I wish more people would ask it beforehand, like you're doing. But yeah, first of all, every pitch deck looks good.
Yeah,
Nobody's ever put a pitch deck together that says,
it
hey,
looks very impressive.
yeah, every pitch deck that's put together for any real estate deal is going to look good. I worked at Credit Suisse in Wall Street, and we would do projections. I went through a credit training program, analyst program, and when we would lend money to companies, or because I was on the debt side, syndicated finance, and we would do projections. And the projections, I can make a spreadsheet look any way I want, and I can convince you that that's what's going to happen. And the problem is, and I did this actually on a live call, and I did a live real estate investing event. And I am actually doing another event on August 10th and 11th in Miami Beach, where I will do this again on real estate and on stocks. So it's both. But on real estate, I took, like, have you heard of Grant Cardone? I took one of his pitches.
Okay.
And he's very, big on social media. And he tells you his numbers on page 35. He doesn't tell you any numbers until page 35 of the presentation. And actually the numbers kind of matter a lot. And I put it on a spreadsheet, and I realized his assumptions were crazy. For instance, he thought that he would refinance. Now, not knowing anything about markets or anything really, how many of you can predict interest rates will be 3% in 5 years from now? That's like
Yeah.
a very hard prediction. But he actually had that in his presentation. He also had in his presentation that rents would go up 3, 4, 5% a year for 10 years. Now, I've owned real estate since 1998. I got news for you. And anybody owns real estate for any amount of time, that's not how it works. It might average 3% over time, but you have years it's up. I had years it was down. I owned real estate in New York City, apartment buildings. From 2014 to 2019, it went down. It was basically flat.
Yeah.
It didn't get back to the highs for 5 years. And then pandemic dropped 30%. Then after the pandemic, and now we're 30, 40, 50% above. So it averaged out, but it doesn't go in a straight line. Now, the problem is when you're looking at these deals, and I'll get to management. I'm sorry, I got on a little tangent. But when you look at these deals, you cannot, those assumptions are a big deal. And so people are telling you, and again, I can make a presentation and they know how to make it look good. You cannot rely on that. So now when you get to management, the big thing is how long have they been doing it? Because as I noted, if you got involved in real estate in the last 15 years, now you deserve credit for maybe buying in 2010, 11, 12, 13 at the lows, and you were able to build a track record. But a lot of that was the greatest time in the history of our country in terms of asset prices going up. Interest rates were zero, and interest rates affect the value of all assets. So ideally, you would like to see a track record that goes back, a lot farther than that. That's number one. Number two, I would ask them what deals they did in 2021 and 22 and how they're performing. Because if someone just bought every year and then bought right off a cliff and didn't realize that valuations were too high, I saw they were too high because I know how to value assets. It's not that hard, but you do need to know a few things about that. So I would ask those questions, how their deals did recently, and this is a big deal. Remember, you're tying up your money. If it goes wrong, you can't just say, hey, send it back. If you're investing in the stock market and you make decisions, if you are really wrong, if you actually picked an individual stock, which you probably shouldn't do, most people, but if you did and you're wrong, you can sell it. And you cannot do that in real estate. If you're in and the person you're investing with made a mistake, you're taking the ride with him down and probably to a loss.
Yeah, well, it sounds really scary.
I didn't mean to
don't,
scare you.
no, no, no. But I'm learning as I'm going, and that's why I'm so interested in what you have to say every time I speak to you. But it sounds like the markets, everything is sort of like a crapshoot. Or should I be looking for some patterns? Can you give us like a little bit of a history of pattern, what
Yeah.
we've been through, and what's to come in a reasonably educated way that I can figure out if I should invest in, what
Yeah.
assets. I mean, I want to
Yes.
learn about the patterns, or what is it some
Yes.
predictability?
Yeah. So, like at my Warren Buffett once said, if you go to business school, they teach you a lot of stuff which doesn't work for investing because they talk about efficient market theories and all this stuff, which is not true. Because if it was true, Buffett wouldn't have returned almost double the market returns for 58 years. That's not an accident.
Yeah.
All he was doing was valuing assets. So the key thing, there's two things. A, you have to understand markets. What I'm trying to do is wake people up because there's a lot of sophisticated, shrewd people who they learned how to raise money and they learned how to make presentations look good. And there's a lot of them around. There's big seminars that teach you how to do it. And so then they go out and they raise money and they might be good people. I'm not saying they're bad people. They might think they just also have overestimated their ability because they were told at the seminar it's easy. And so they go out and then they're at your house and they're saying, hey, invest in my deal. You have to be smart and you have to be shrewd. Again, if you're a high income earner, these people love to go after you and doctors because you guys have extra money to invest and you're not going to be sophisticated investor. Not made it so. It's just not your business. And so you're not going to ask the questions. So what I'm teaching people is how professionals look at it. And so the thing is, with a few distinctions, the ones I mentioned, but really it's not a crapshoot. People think markets are a casino. Let's say stock markets. So there's two parts of the stock market. There is the casino that goes on over here. Every day markets are up. Yesterday they had news. Israel bombed Iran. Oil prices went up. Oil stocks went up. Some stocks went down. Nothing changed in the fundamentals of the businesses where the stock went down. Nothing changed. It's just all the casino making predictions about the future. Now, there's a whole nother thing going on that very few people participate in the stock market. It's what Warren Buffett does. He actually looks at those businesses that underlie those stock ticker symbols. If you buy a stock, people treat it like I'm going to go buy a stock. Why? Because that sucker's going up. Like that's how they buy stocks. That's going up, I heard. But underneath there's a business. So if you can understand the business and you can do the things, what I call the framework, that's what I teach people how to do. It's more than for on a call, but at least you can have this knowledge and people can sort of wake up to the fact that, hey, there's a little bit more to this. But actually the beauty of it is when you understand it, you could sit there while the casino's going on and the markets fall and you know the business underlying, you could buy great assets at cheap prices. Right. And this is the beauty. And that's why Warren Buffett's wealthy. He always said, because most people treat it like a casino. And the same thing happened in real estate. The difference is real estate isn't quoted daily. Like you don't walk around and there's a quote ticker symbol on that apartment building on the corner. It's saying the price today. It doesn't work like that. It's a privately negotiated deal.
And there are no shows about it on CNBC about
yeah. Yeah, not really. There's some flipping shows, and which is usually not a great thing unless you're very, you have to learn that too. I show people how to do that, how to buy multifamily, how to buy stocks, which are pieces of businesses. But there are some distinctions you can make that will make you a huge advantage over everyone else because most people just operate very superficially in this area. But real estate is in a very efficient market. Very rarely do properties just plummet in price. Now, it happened in '08. It happened in 1991, 92. And to some extent, it's unraveling a little bit today. The problem is that there's so much money looking to buy real estate. And it's sort of the first line. People like real estate. I get it. I'm a real estate guy. I bought my first property in 1998. But people like it because they can see it. They it's a building. It's easy to understand. I got my rents. I got my expenses. When you're looking at a stock, people think, I don't know what the heck that company does. They operate all over the world. It's a gamble. And the reason they think it's a gamble is because they've operated in the casino thinking that was investing. They were buying stuff they heard was going to go up. It's really completely a different world when you understand what I'm saying. I love the public markets, even to an extent more than real estate these days, because I can see things that are mispriced, pretty frequently, and you can buy these assets, and you also have the ability, if you're wrong, because people are wrong about stuff. Even professional investors make a misjudgment, but we don't lose a lot or anything, and
Yeah.
we can exit it. Again, if you're in real estate, very hard to exit if you made a mistake.
Yeah. Well, so next week when I have this call with this guy, a good friend of mine, what two questions do I need to ask him?
Well, I would ask him how long he's been in the business, and I'd ask him to show you the deals he did in 2021, 22. I would ask him because that will say a lot if they tell you, because a lot of the guys looked really good for a long time, and then they just bought at the highs. There's people who, they taught seminars and they would say things like cap rates don't matter, and in real estate that basically means valuation doesn't matter. There's no asset so good, real estate or stock, that you can pay any price for it. There's
Right.
such a long history of that. How many do you remember Polaroid cameras?
Yeah, of course.
One time in 1971, two, around there, it traded at like 100 something times its earnings, and people, it was a part of the group of stocks called the Nifty 50, they called it.
Okay.
Polaroid, NEC, and that stock eventually went down 95%. But at the time, nobody could see it. They were like, this is the greatest thing that's ever happened. Polaroid cameras, you get an instant picture. Can you imagine? It's kind of like AI today. You say, AI, this is incredible. But history shows that these things, what happens is the hype comes, and then retail investors buy it, and things go to crazy prices. I'll give you one example if we have time.
Yeah.
Another one, which I think is very interesting. It's recently. How many people knew in electric cars, like look back up 5 years, how many knew that they were going to sell more electric cars every year for the next 5 years? Like companies that were in that business, it was pushed by every government, right? They gave incentives. So you
Yeah.
had a company called Lucid. Lucid, how many have heard, probably heard of Lucid, the electric car
Right.
maker?
Yeah,
So a
yeah,
lot of those companies, they were so highly valued. So people got very excited about the technology, and they correctly predicted that every year they would sell more cars. But that didn't matter because the prices got so out of whack. People bought that stock, which is now down 90, 95%. And the reason is the valuation got so high. So the valuation, just as an example, you've all heard of General Motors, Cadillac, Chevy, Buick. They sell millions something cars a year. They sell a lot of cars. The whole company of Lucid was valued at half the value of General Motors, and they sold 130 cars in the second quarter of 2022. 130 cars Lucid sold, and the stock market, the gambling casino had valued it. The gamblers had valued it at half of General Motors. Can you imagine? If I said that to anybody, you would say that's crazy, but people didn't know how to look at it. They just bought because it was going up, and of course that's why it fell.
So with valuing assets, do I need to take a look at their P&L? What do I
Yeah,
need to
so
take a look at?
we well, basically, we'll look at cash flows. So coming back to real estate, which is a little simpler in some extent, I think it's harder to do for most people, actually, and it's the opposite of what they teach you. But I've come to realize that I do it. I love it. I bought properties a long time ago, but I don't buy anything now because prices are generally too high, every time I look, I don't even pay that much attention to
You
multifamily,
mean okay? You talk.
apartment
Okay,
buildings, things like that. There
yeah,
are assets, offices, which are depressed, but you really have to know you have to really know a lot to do offices, and you have to have a lot of capital because you're going to have to do a lot of renovations to attract new tenants. Anyway, valuing assets is basically the cash flows generates. This is very simple. There's three types of assets. There's cash or cash denominated assets. You put it in the bank, you put it in treasury bills. They're denominated. Now, over time, there's only one thing I can pretty much guarantee. I can't guarantee anything else. I can guarantee that the value of the currency will probably go down over time. We all know this, right? Your purchasing power goes down. That's why you must invest, because you will
yeah,
lose your purchasing power.
yeah.
How much a dollar is worth. Okay, that's one type. Second type is productive assets. That's what you should focus on. So if you buy an apartment building, it's a productive asset. You're collecting rents. It has utility value, and that cash flow flows in your pocket. The amount of cash flow you get from that property, and then predicting out over time, is the value of the business. So there's a little bit more to the formula. If anybody ends up coming to, I have a lot of people coming to the event, but if any people on this call end up coming in Miami Beach, I will show you how to do that. It's simple. I use a spreadsheet for real estate. I don't use it for stocks. The thing about real estate is you have to be correct. Again, if you make wrong assumptions, you're going to be stuck in a property, and you're going to be getting a call from that guy, and he's going to say, hey, things didn't go quite as expected. We need more money. And that's a lot of people are in that position now. But that's the second type, productive assets. A business represented by stock is a productive asset. That business is out there selling goods and services, generating cash. The value of all that cash flow, which you can read on their financial statement. And places like Yahoo Finance, you can go to the cash flow statement. You could look at their free cash flow, what we call it. Free cash flow, basically, in real estate, that's the money after you paid all your expenses. It goes in your pocket.
Mm-hmm.
Companies have the free cash flow. The thing that confuses people is the companies don't send all that money to the shareholders. They might send a little. That's called a dividend. But a great business takes that cash flow and reinvests it, and they can grow the business. So you want to identify great businesses. That's the actual sort of tagline of the event I'm doing. It's called Professional Investing Boot Camp. It's not, you don't have to be professional. I have people of all levels. But basically, it's if you want to get to a higher understanding. And the tagline is how to spot the great compounding investments, because that's what you really want to do. And secondly, how to avoid the myriad of bad offerings. There's so many bad offerings, and they all sound good when they're presented, and they all will.
When
So,
what's that red flag look like for bad
oh,
offerings?
I will tell you a couple things, but let me just give you the third type of asset. I
Yeah,
didn't say a
sorry.
non-productive asset. Non-productive. This is like Bitcoin or gold. Now, gold has a long history. Bitcoin is relatively new. These things don't produce anything. The the Bitcoin on itself, if you weren't allowed to trade Bitcoin, the value would be very low, because what are you going to do with it? You can't do anything with it. If I wasn't allowed to trade my apartment buildings, and I wasn't allowed to sell or buy them or do anything, I still got cash from them every month. So it has value. Do you see that? And
Yeah.
so people have a lot of trouble understanding this, but typically non-productive assets are not going to be great. Even gold, which has gone up a lot recently, for 100 years, the average annual return is about 4%. You basically maintaining your purchasing power, because inflation is around 3-4%. Now, red flags you asked about. Anytime people are saying things that are hypey, like even if they could be right, but I won't do it, because people talk like this are amateurs. They say it's on fire. I saw a post. They said we can Arizona real estate. All the millionaires are moving. There's not enough houses. It's on fire. You can get involved. We're doing private lending to builders to build houses. Now, this is building houses on spec. That's called on spec. You don't have a buyer. This is, even if you knew the person, it's a difficult business. Because let's say, and they say, oh, well, it's secured by the real estate.
Yeah.
But if they don't finish the house, what's the house worth? Like if it's half built and they default, you have a half built house. Now you got to pour all this money into it. So anyway, people say hypey things, and then there's a picture of a guy with a Ferrari and a jet, which I think is AI generated, which is really easy to do these days. So I don't like hype. The actual good investments, I'll tell you the real secret, the good investments are not widely promoted in most cases. So this is a deeper conversation, but the things that are hyped and promoted and pushed relentlessly are usually at the tops of markets.
Wow,
In
that's a
real
good.
estate, everybody was pitching it. Doctors were pitched. It was big seminars. You're a doctor, come, we'll teach you how to buy real estate. And the people teaching it, they're good people. They're not bad people, but teach a very simplistic thing. And a lot of people are in assets that are not that great. You can't just buy real estate and say, oh, real estate always goes up. That's what I heard. Literally at these seminars, they say real estate always goes up. Well, yeah, over time. But if you have debt and you can't pay your bills in the meantime, you can lose your building. And
Yeah.
so there's a lot to that, but we go into that in depth in the event.
Right, right. Well, one follow-up questions on one follow-up question on productive asset. Um, is one better than the other? Is Airbnb better or
Well,
multifamily units better?
if you're going to do real estate, Airbnb, keep in mind that's a business.
Hmm.
Like it's more of a business. Like you have people coming in and out. It's a lot more labor intensive. Now people say, well, you can get other people to do it. I will just tell you, anything revolving around real estate, they always sell it like it's easy. And I've owned real estate since 1998. So I have a little experience in this. It's almost 30 years, 27 years, whatever. And I'm telling you, even if you have a great property manager, a great person renting your apartments on Airbnb, you have to manage these things and you have to be involved. It's a false statement to say it's passive. Now, the only caveat is that if you're a limited partner in a deal with, they're not going to ask you to do anything, but you have to be sure that that person is got a long track record and is right. And this is very hard judgment for people to make. It's a very hard judgment. They overestimate always. Why? Because they get a good feeling from the person. They like the person. The person might be a very good person. They're not a bad person, but that's why I go to track record and look at how long they've been doing it. Have they seen cycles? And how did they perform in those cycles? I think
Right.
did I answer your question? I think I
Yes,
lost.
yes, absolutely, absolutely. Yeah, it sounds like Airbnb is definitely, I never thought of it, the distinction that it's actually a business, while real estate can be a little bit more passive.
Yeah, well, you can have a manager and
Yeah,
stuff. It's just, you get a tenant and they stay for a year or 2 years or 3 years. So it's not as much turnover. There is work to do. There's maintenance. But Airbnb, they come in and out every few days. It's like, and you're going to have complaints. You're going to have this and that. So do you want to do that? If you are, your expected returns must be much higher. You cannot say, well, I'm going to make 10 or 15%. First of all, I wouldn't do any multifamily deal that conservatively is in the mid-teens IRR return. It's just not worth it. This is a whole nother discussion, but if
yeah,
you're locking your money up, but in the stock market, historically returned about 10 if you did nothing but buy an index. Now I could do better than that by doing different things. And I've posted my returns to various groups. I show them what I'm doing. I'm beating the market right now. I just looked last night, year over year, I'm up 18 something percent. Market was up 12.
wow.
So a little bit better than the market, but that's not taking account to today, but actually I'm not down as much as the market today because at least at the open, I haven't looked since we've been on this call. But
Yes,
the point is that, real estate, you're locking your money up. You have to be super careful. That's why I put it on a spreadsheet and I look out and we project it. And people who come to the event, I will show you that in real time, doing real deals on a spreadsheet. It's not that hard. I have a discounted cash flow sheet, which is different than most real estate investment conferences. They don't give you it's more complicated for this call, but they don't give you the proper professional sort of way to look at it. It's okay what they show you, but there's another level sort of.
Great, great. And so, with I know we didn't talk about stocks or private equities as much. So, are the same framework work for the public
Yes,
markets?
everything. And I'll tell you this: if there's one thing, and I think you're gonna might have thought to ask me this, but if there's one thing that I can tell you is the most important thing in everything you do in life is the people you get involved with, and especially in the investment world.
Right.
It judging the character, it's very difficult. And a lot of times innocently, especially if you're a good person, which most people are, they assume other people are equally good and qualified. So again, a lot of people are pitching investments. They are good people, but they're not maybe experienced. And
Right.
that's why you have to dig really deep on it. But really, like I've shown people, I did a call that was a public call, and I showed people this thing with the Grant Cardone deal and something. And I'm not knocking Grant, but he's the case where it is a lot of salesmanship and hype, and none of his investors really ask questions. And I have a good friend who I met after they had invested, and they're getting 1%, on their cash.
Oh
And
God.
and that's not how the deal was sold. Now it's better than going to zero, because I have a lot of friends in deals with less prominent people who went to a seminar and started raising money. I mean, this is crazy. Imagine if I came to you and I said, I went to a seminar, Shefali, on how to be an optometrist, and I'm
Yeah.
going to start practicing tomorrow. You'd laugh me out of the room, and I'd probably go to jail. But the point is, people do that in the investment world all the time. They go to a
Right.
seminar and then they're raising money,
Right.
and there's
Right.
no law against it. But
I
it's
know.
absolutely ridiculous if you think about it.
Right. Well, in last question, in today's geopolitical world, where with possible war escalating between Israel and Iran, do I keep my cash under the pillow or
Well,
deploy
that's
it
again,
if
that's
the
a
market goes down?
yeah. So I don't. It's been proven throughout history. And again, I'm not a financial advisor, so I don't know your personal situation. So people should go to an advisor, because you really should have a plan, right? A financial plan. I think this is how much I make. I can afford to invest this much where I don't need it. Because first of all, if you need money in a year or 2 years, you cannot buy stocks. You shouldn't buy real estate, because
Right.
I can't tell you what's going to happen even tomorrow. I couldn't have told you 2 days ago what would happen yesterday, although it's became sort of you could guess that something was going to happen with the Israel and Iran, because they were clearing out the embassies and stuff. But I can't predict it. If you want to predict the market, go watch CNBC. They'll tell you exactly what's going to happen. But like, I can't. It's above my pay grade. But I can predict sort of long term, and I know how businesses work, and I believe in it. If you believe in the system, the American system is a very good system. So timing markets is hard. It's hard to predict. But here's the thing: if you just do what I'm saying, if you're always valuing things, like I had a lot of oil stocks, because why? They were cheap. Oil, was down for a while. Trump came in. He's going to drill more oil, creates more supply. So prices were down. But the stocks are really cheap. The other thing about oil stocks is people cannot buy them, institutions, because the ESG rules.
Okay.
People don't realize this, but there was all sorts of social political rules. You cannot buy oil stocks. So big funds couldn't buy them. So the stocks were cheap. Now, my point is this: when the Iran thing happened, those stocks went up. Some other stocks went down. But if you're always buying things at a good value, investing is buying something for less than it's worth.
Yeah.
That's all it is. And so you're trying to say, I want to buy something, so the value of that apartment building over 10 years is going to be worth. That's how you look at the cash flows. It's all about the cash flows in a
Yeah.
business too. And then you figure out what it's worth. There's formulas. Like, it's not, I don't want to get too into the weeds on this call, but there's a couple extra steps. It's not overly complicated. So I wouldn't be just waiting for stuff. But again, that's a personal situation depending on how much money you have. I'm
I
I'm
understand.
invested. I also have cash. because there's things I might want to buy. And so, it all depends on personal situation.
Yes, everybody should be consulting with a financial planner. Yes.
Yes.
Well, David, that was really, really informative. Where can doctors learn more about you and follow your work if they want to take the next step?
Well, you can go to theultimateinvestor.com. There's a thing there, you can put your email and you can read something called the 20 rules to know to stop making dumb investments, which is a sort of cheeky title, right?
Yeah.
It's like a funny title, but I wrote that, and actually that's how I ended up on Tony Robbins' stage, because he read some stuff I was doing, and I was helping a lot of people who were having a lot of problems and lost money, and he put me on stage at an event where I spoke. Ray Dalio also spoke there. Jamie Dimon, Jeffrey
Yeah.
Gunlock,
I was
Howard
there.
Mark.
Yeah.
Yeah, you were there.
Great.
And now I speak regularly at his wealth mastery events. But that's how it started with that. And actually, Wiley, the publisher, I'm doing a book with them, major publisher, somewhat based on that. And then also I'm doing an event in August in Miami Beach, August 10th and 11th. It's at a beautiful historic beach club called the Bath Club, and we have a hotel room block right up the street. So that event's going to be great. If you like what you've heard,
Yeah.
and you understand what I'm saying, you really want to be there. It could be completely life changing. On the one level, the main thing is don't lose money in investments. That's Warren Buffett's number one rule for years. I don't want to lose money. And people always look at the upside and they don't look at the risk protection. And just that alone could be worth a lot of money. I've had people come to me, they lost their life savings in a real estate scam. I've heard so many bad stories.
Yeah.
Just that alone, I think you will have such a huge understanding. I know you will. And secondly, then we'll spend time looking at how to identify great assets. I'll show you actual assets. I'll show you real estate deals in real time. We'll evaluate stocks in real time. You'll know how to do it by the end. That doesn't mean you're an expert at it immediately, but people will understand. And actually, the investing game is more an emotional game and understanding markets and a little bit about valuation you need to know than it is some kind of financial, like you don't need to be a financial analyst is what I'm saying. So
Right.
you can go to that. It's in Miami Beach. There's a very complicated so I see you guys posted the email thing. I don't know if they could maybe get a link there they could click
We
on.
will. We'll share the, yeah.
Yeah. But
For
it's
sure.
in, but you could also go to theultimateinvestor.com, put your email in, and you'll be on the list. We'll send out information about the event. So
Yes.
that'll be great. I'd love to see you there.
Good.
We're gonna have a great time. I don't really do events. It's my third one. I like talking to people, but events are very time consuming to put on. But we are gonna do it. It's gonna be incredible, and hope to see you there.
That's good. Where can we hear from you regularly? Do you put out podcasts or YouTube
Well,
chat?
I I'm not really like I'm an investor. So I'm not really big on social media at this point. I have X I write on at David Leiter. Um, Instagram's at David Leiter. I don't post a ton, and I'm going to be doing more. But you have to understand, like I was doing this out of sort of a mission, a disgust against. I saw so many people that were
I knew
good
you were. Yeah.
people, and I was just started like, guys, I just really, I know a lot about this subject. I'm not somebody who is teaching it, and that was like my main business. Was already retired from investments. I'm doing this and I've enjoyed it. So and it is a business at this point, but I spent a lot of time, 6 months or so. I was just talking to people. I was just disgusted. So you got to get smart, especially if you're making a lot of money, you're a highly educated person, you're a doctor, you know, you work hard for your money, and it's a myriad of landmines out there for most folks, and they don't know how to distinguish, and I can help you with that.
Thank you. Thank you so much, David. Thank you. This has been incredibly insightful for me, and I hope for our listeners as well. You can find more information about David on his website, theultimateinvestor.com. David is hosting a professional investing boot camp, as he said, a 2-day workshop on how to spot great compounding real estate and stock investments and how to avoid the mediocre and the bad ones on Sunday, August 10th and 11th in Miami Beach. If you're interested, we are going to share the link to register to his event. Remember, finally, it's not just about income, it's about wealth, and wealth gives us the freedom, options, and peace of mind. See you next time. Thank you, David.
Thank you.